Welcome back to Real Estate Mindset, you guys. Happy Monday. It has felt like it's been years since I've done a live. I have Mitch Vexler here. We're going to go through a wealth of information, and I want to let you guys know that everything will be chaptered in the description once we finish, and to please ask your questions as we make our way through each segment of this video. I'm also going to pull up some questions. If you guys have any, it doesn't matter if it's the housing market, economy, whatever it is, share your questions below. And before we begin, and I'll tell you guys what the chapters are here in a second, Mitch Vexler, happy Monday morning. How are you, sir?
Good morning. It's good. It's a little chilly out. It's a balmy 27 degrees here in Texas. So it's a little chilly.
And good morning to you as well, Mary. Good morning I see a lot of you guys here. Good morning, Staple. Good morning, Sunshine. Retired. There's Vovo. I love my Vovo. This dude is the man. I've been with Vovo, and Vovo and I have been talking for, 2 years, Vovo? Denise, good morning. Good morning, everyone. Good morning. There's my buddy, Scrog. Oh, my gosh. I got to do these more often. I miss these people so much, man. They've made such a difference in my life. And hopefully we're doing the same thing. So I want to let you guys know how we're going to do this video today, how everything will be chaptered. So we're going to start by talking about the bond market. I'm going to get Mitch's opinion as well about the debt ceiling, about the deficit, inflation coming down or not. The second segment is going to be more specifically about inflation. And each segment, you guys, we're going to go over a video as well. So it'll be segment, data, video, and then opinion. Third section is going to be about mortgage interest rates. You guys love, I love picking apart amortization schedules. So we're going to go into a mortgage update. Fourth segment is going to be about the Federal Reserve and property taxes. We're going to go over the Zero Hedge article that Mitch Vexler did. Mitch Vexler is in Zero Hedge. Congratulations, Mitch. And another report that he did, he made last night, I believe, or yesterday, called Quantitative Tightening versus Inflation. They're happening at the same time. So that's kind of weird, Mitch. So before we begin, anything you want to say before I get started here, Mitch?
No, let's just get into it.
Okay. A couple more good mornings. Good morning, Paul. There's Paul. Man, Jungle Book. 100,000 violations for chicken coop. That's nuts. That's crazy. I don't know what that's going on. Mitch is amazing. Appreciate you as well. Awesome. Glad you guys are here. All right, so let's get started here on our first section, which is going to be the bond market. Let me get this timestamp real quick at 2:40 so that the viewers can come back here. But we're going to start right here. Now, Mitch pointed out right before we started that gold started tanking. So gold is down right now. Started the morning right before market open up. And you guys can see this downward trajectory. Not 100% sure why that is. It's probably potentially has to do with Biden saying no to the steel contract. But as we move on here, going into the bond market, the 10 years on a bit of a roller coaster ride this morning, probably with a gap of about 6 basis points. Right now, it's up 2 basis points. Very interesting. 10 years started up all morning, and then it kind of cratered down into being negative, shot back up. This is the long end of the yield. The reason that this is important to so many Americans is this ties directly to residential mortgage interest rates. If you guys want to know what's going on with mortgage rates, we should be able to call a loan officer or our banks or a mortgage company and look, it just went negative right now, barely. But if you really want to pay attention to mortgage rates, just watch this 10-year treasury, the longer end of the yield, and that will tie directly into the mortgage interest rates. Now, as we keep going here, talking about the bonds, the 10-year and the 2-year are no longer inverted. They have been uninverted since right here. Quick uninversion right here in August, and then it went inverted again, and then it went permanently uninverted at the end of August. But I'm telling you guys this because typically it's, if we look at the history here, okay, going back, let's go max back here. Typically when it uninverts, when it goes over that black line, is a period of 6 to 8 months before entering a recession, which would mean, Mitch, please don't beat me up here, okay? I know the data is manipulated, brother. I know they're lying to us. I know all these things. But if we are only looking at this one data set and we were to look back in history and we were to add it, divide it, 6 to 8 months before recession, which would mean Q1, possibly Q2 of 2025, if we just look here, okay? But when we look as well, what the Federal Reserve plans on doing next with the federal funds rate, remember, you guys, they cut the federal funds rate and all other interest rates went up, okay? They probably don't have control, or the market's figuring out, oh, yeah, that's right. If they cut interest rates, that means that there's something wrong with the economy. The Fed does not cut interest rates when the economy is thriving. Why would they? It's thriving. All right. So here's what the market is thinking as far as if they're going to cut rates in January. About 91% of the market saying no cut in January. All right. In March, 50-50. Now in May, about 50-50. When we get to June of this year, it goes to about 27% likelihood of no rate cuts. In other words, you guys, the market doesn't know exactly what's going to happen next when it comes to interest rates. So what we're going to do is let's listen to our first video. And as I'm playing this video, you guys throw up your questions. And after the video, we'll go ahead and respond to that. But this first video is going to be about the bond market. So I hope you enjoy. I'm going to mute us real quick, Mitch, and let's get started on the first.
For that is Tom Tesouris, who is Strategas Securities head of fixed income and research. Also, he's the lead fixed income portfolio manager there. And Tom, thanks for being with us this morning. What do you think about this conundrum we've seen in rates? How, the rates have had their own mind. The Fed hasn't really had control here.
Yeah, and this has been a very bad year for the bond market. And it's been a year, in fact, where both bears and bulls have looked like they've been wrong quite a few times along the way. But we would agree fundamentally with why yields are rising at this point in time. But we just think the bond market's getting a little bit ahead of itself. In particular, there's a few headwinds to further increases in yields that are likely to hit in early 2025. And so those headwinds have to be dealt with before yields can keep creeping higher. But fundamentally, it makes sense that yields have crept higher, even as the Fed has cut, because one, the market had priced in too many rate cuts for 2024 and 2025. And two, the market was looking past at that point in time when 10s were down to 360, the enormous supply that is going to have to come on board in the next few years as the Treasury, one, continues to finance large deficits, and two, begins to refinance the Treasury bills that the Yellen Treasury had pushed into the market over the last 2 years. So that has to be dealt with. And this is the big reason why yields are rising. But we got to get through this soft patch in the first quarter of 2025 that we think is going to hit. And we also have to get through the debt ceiling increase, which until that debt ceiling is increased, there's going to be a shortage of treasuries entering the market for at least a few months in 2025. We got to get through that too. So shorts are going to have to be very cautious about maintaining positions with yields at these levels, because there's a lot of chance, a lot of risk that yields reverse drastically lower in the next few months.
I mean, I guess the good news is you're not talking about an inverted yield curve, at least between the 2s and the 10s anymore.
That's correct, especially with the Fed still likely to cut at least 2 more times next year, likely in March and in June. And even if they only deliver 1 more cut, you're looking at the Fed funds rate down to 3.75 to 4, and 2s around 4%. So 2s 10 spread should still be positive in 2025.
You know, the point you made about Janet Yellen and the treasuries that had been issued to this point, you're saying that that's the biggest reason for the issues right now because of the length of duration?
Well, it is as of today, but if you assume that we're going to be running $1 trillion plus deficits beyond 2025, then eventually, cumulatively, that will overwhelm the T-bill issuance. But we've estimated that between, we'll say, 2022 and end of 2024, the Treasury pumped about $2 trillion of excess T-bills into the market. Those are going to have to gradually be scooped and tossed out to the 5 to 10-year portion of the curve majority. And that is probably a bigger concern for the market right now than deficit next year. The deficit next year should actually come down materially versus 2024. So it's scooping and tossing those bills that's a bigger concern at this point in time.
Big question, though, is what happens with inflation? Is it stickier than had been anticipated? And what about the economy? How does it hang in there? What's your answer on those 2 fronts?
Well, I think they're going to be working against each other for much of next year. And what we mean by that is that inflation is probably going to be coming down for a little bit next year into, we'll say, end of first quarter. We think inflation is going to trickle a little bit lower, and then it's going to get sticky again around a 2.25 to 2.5. We're kind of there right now. And then during that period, you're also going to see, we believe, a soft patch in the U.S. economy, driven in large part. I think CNBC has written about this recently. Credit card debt, it continues to be a drag on the consumer, and that drag hits hardest in the first quarter. So we think there's going to be a soft patch next year. But then, if you assume the economy reaccelerates, inflation is probably going to be going with it higher. So you're probably going to see in the second half of the year, you're going to see inflation trickling back towards 3%. And by the end of next year, it might be above 3%.
All righty. So few things here, Mitch. I want to, and we're going to get to Jungle Book's question. That's a great question. Let me minimize this real quick. But, okay. So my first thing here, Mitch, is, he mentioned inflation coming down at the start of the year, but then picking up. It's so hard for me. We'll get to the government deficit. The deficit is 64% higher than last year, which was the third highest year of deficit spending, inflation. Do you think that he's right about inflation coming down at the first part of the year?
No.
Why would he say that then?
Well, key words that he said. Now, he seems like a nice guy. He's well-spoken. He's speaking his book. So we'll give him the credit for what he's saying because he's speaking his book. However, 50% of these questions that are being asked are completely being ignored, right? And so coincidentally, I didn't know you were going to play that clip, but if you look at that document, the quantitative tightening versus inflation, and go to paragraph 2, it literally destroys everything he just said because he's missing 50% of the equation. It's not what he said that is the problem. It is what is missing, what is being omitted that is the problem. And he did say that the Fed pumped in $2 trillion, but where did the money go? Well, the answer is it went into the banks. So paragraph number 2 under the quantitative tightening versus inflation literally says exactly what this problem is. So
okay. Now I was gonna save this for the end, but you know what? Perfect time to read it. Do you want to go over paragraph number 2 right now, Mitch? It's right here on the screen. You see that?
Well, what paragraph number 2 is saying is that you have a schizophrenic behavior of the Fed. So they call it quantitative tightening, and then they turn around and then they call it quantitative easing. Well, the net result of either one of those is schizophrenia, because if you tighten, that means that the Fed pumps less money into the banks. If the banks have to have reserves, that forces the banks to raise capital and or slow down their lending to the public or to the corporations. Well, think about it. If the banks aren't pumping money out, what happens to mom and pop? Their ability to get access to the money, mom and pop even being corporations, small businesses, their ability to get access to that money decreases. That's quantitative tightening. So the Fed's theory is, well, we'll tighten it up to slow inflation down. No, you morons, because that slows the economy down. It's the exact opposite of what you want to do. And that is why I've said the Fed, since its inception, has never been on the right side at all of a decision. And I've studied the history of the Fed. They have screwed it up, taken the exact opposite, which hurts mom and pop. Now, why do they do that? Well, because they're not there for mom and pop. They're not there to help the economy. They're there for the banks. So the flip side of the coin is, well, if we hurt mom and pop, we help the banks, we help stabilize the banks. Here's an idea. Let those banks that aren't able to understand what they're loaning money on and made bad decisions, let them go bankrupt. Goodbye, good riddance, because that is the only way to help mom and pop. So if a bank holds assets on its balance sheet, that's a good thing, right? You come in, you get a loan, that bank has your loan. That means that bank knows what your business is and they're not selling you off to the next buyer down the stream. So the point of the matter is, you've got a situation here, and that's what paragraph number 2 is talking about. This guy that was just on CNBC, like I said, nice guy, well-spoken, missing half the equation. If you slow mom and pop down at the cost of inflation, you have screwed this up. And that is where we're headed.
Well, that's exactly how they slow down the economy, is with the inflation. So we'll get to the inflation part here in a second, but let me ask you this as well. He also made a comment that he expects the deficit to come down. I'm wondering why do you think he made the comment that the government deficit will come down, being that, and it starts October to everyone, so the fiscal year starts October, being that it's 64% higher than last year. What part of the overwhelming deficit spending that's going on right now is this guy missing, Mitch?
Well, he's probably thinking that Musk and Vivek are going to accomplish something, which may be true. Okay. However, that's by shutting certain divisions down and being more efficient in the government. There are ways to accomplish this. Um, there's a meeting coming up on Wednesday that I was invited to late last night with a government official. I've got something to say about this. I just can't do it at this very second. But there are things that can be done. But he's guessing because he doesn't know, right? Nobody knows what Vivek and Musk are going to be able to be capable of. So to me, it's a hot air point. It just doesn't matter. We've got something that's quantifiable that would make a huge difference, massive, in about, give or take, 1.4 trillion worth. So there are ways to accomplish the goal. The question is, will the legislators get on board in order to accomplish the goal? And what we've seen here in Texas so far is nope.
Well, hopefully Musk lays off, as they're saying here, hundreds of thousands of government employees, especially the ones that we don't need. Mitch,
Well,
I want to get to
that's a start, but it's a small portion, right?
It
This
is
is a finance issue more than it is a people issue.
Greed, corruption, apathy. I mean, there's so many levels of this issue, but I want to get to these questions, Mitch, so we don't spend too much time, because I like to give the viewers kind of just right to the next thing. Now, here's a question I threw up from Jungle Book. This is good. Jungle Book is asking, and Jungle Book, thank you for being here, brother. Appreciate you. He's been here from almost the beginning. Question for Trav. Why is the 10-year so volatile? Does the decrease in spending, why is that comment only showing? Does the decrease in spending by consumers play a role in the 10-year volatility? I would say, Mitch, and I want you to knock this out quickly because I have a few more. I'm just going to, one of the things is because a lot of countries, one of the things, other than the overwhelming amount of 10-year treasuries and treasuries that they're printing, China, Japan, there are countries around the world that have billions, trillions of dollars in treasuries. So when those countries sell or buy treasuries, it manipulates our markets. That's one thing. Mitch, can you go ahead and just add anything else to that comment right there that you'd like?
Well, okay. So treasuries are the cost. It's the interest, but it's the cost of the government doing business. So the government sells bonds, and those bonds are floated around the world. In many cases, that's our garbage being floated around the world on purpose through the Federal Reserve. And the interest rate on those bonds is the treasuries. So the interest rate being at 4.25, well, that's the cost or the interest paid to other entities. Now, your money, your pension money, your 401k money, if you're invested in bonds, you're getting a yield. If you're invested in treasuries, you're getting a yield. So the 10-year yield hovering around 4.25%, that's the cost of the Fed funds. So when they pump their bonds out, that's how much other people are paying to get those bonds. So it's a reflection, in theory, of government-related risk. So if you believe that the implicit guarantee of the federal government is solid today, you would accept a 4.25% yield on your money. If you believe the bonds are worth what they claim they're worth, you would accept, give or take, a 4.25% rate of return on your money. However, you're in a bucket. Mom and pop are in a bucket. Their pension funds money gets added to other people's pension funds money. The whole problem with this is that when you realize the debt loads and the truth floats to the surface of the value of the bonds, this will disintegrate. And that's the big problem with what we're seeing right now. You make the economy sick, you make mom and pop sick, you've got 32% of the population, household population, that can't afford the roof over their head. There's an article that Travis just got this morning out of Spokane where they've literally admitted guilt with regard to the real estate taxes. And there's another in Seattle that 35% of the children in the schools are homeless. You start adding these factors up, and all of a sudden you begin to get a whole different picture. That is why we're pounding the table on this, because what you're being told by mainstream media, i.e. CNBC, and what you just saw is a narrative. It isn't the truth.
Yep, good answer, Mitch. And that's it. Really, it doesn't. Maybe it does frustrate me a little bit, but for a lot of people that are on the fence trying to figure out what's going on, who do we believe? Obviously, people's lives, it depends how much money they have. It depends how many goals, how much credit card debt. But for me, working with you, the reason I'm pounding the table as well on the property taxes and overvaluation is because that's happening right now, right in front of us. The bonds, the ISDs, it's all something that could be quantifiable for almost every viewer. Literally, if you're watching this right now and you type in the county that you live in, and then the school district, and then bond debt, and then corruption, it all ties together, you guys. That's why, again, we don't have to speculate and argue because we have the math on that. So really important. I want to get through a few comments here, Mitch, and then we're going to go on to the inflation part of this. This is from Christina. Yep, inflation and U.S. debt equal unmitigated disaster for Americans. Quit sending our money overseas. Can't blame her for saying that. Another one from Christina. She's on a roll this morning. The Fed has one job: to protect their bank shareholders, not to protect you or me. I like that, Christina. That's why we got one more from her as well. We got one from the Pete Mitch. He loves you so much. He took your first name as his last name. I'm kidding, Pete. I appreciate you asking this question. Travis, are you still on track to buy a home in February? That is my goal, my friend, and I will be crunching the numbers like crazy. But again, I'm not willing to settle on very much for my house. I have way more inventory this year compared to any other year. This is the last 2 or 3 years. I have more inventory now, and I have multiple properties, under 120 square foot, some even at $100 a square foot. But another thing I have to look out for, Pete, is property taxes have skyrocketed, and homeowners insurance, especially homeowners insurance, has doubled. So I may have to adjust my price per square foot down a little bit. Thank you for asking, though, brother. I will keep you updated on that. One more from Christina. The Fed is basically a banking cartel that uses U.S. citizens as hostages. I like that, Christina. Don't go anywhere. Stick around. I like her comments. Night Cry. Look at Argentina to see how much change could be affected by cutting excess government spending. It is a long, hard road and will not happen overnight. And that's why I keep telling people, I want Trump. I want any president in the U.S. to do well. I want Trump to do well, but he's not a savior. This government debt existed long before he took office. And so for me, when it comes to politicians, even though I vote, it's guilty till proven innocent for me. And I say that because of the spending. If the spending wasn't out of control, maybe I wouldn't say that, but it's guilty till proven innocent. That's all the comments I'm going to share for right now. You guys keep commenting. We're going to start our next section here, which is the inflation section. Right now at 2240. So let me throw up the first thing with the inflation this is what I wanted to start with here. Okay. Let me switch my cameras here real quick. Now, this is the overnight reverse repo market. This is like, you know what, Mitch, I have so many thoughts and feelings about the reverse repo market, but just for the sake of argument, you guys, this is some of the inflation right here. This is kind of excess money. Unlike the repo market, this is where the lenders can go to lend their money. The repo market is where they need to borrow money. So in other words, we need this money to go away. And this is money in the system. Right now, it's at $237 billion. Obviously, it's lost. It was up about $2.3 trillion, April of 2023. Lots of progress being made, but it really stalled out here mid 2024. It stalled out. We need this money to go away. That is a source of inflation. But another source of inflation is the government spending money that they don't have, spending our money as a taxpayer that they don't have. They don't have my permission to do what they're doing. I don't know if they have your guys' permission to do what they're doing, but they certainly don't have mine. The new Green Deal, the wars overseas, the immigration, hundreds of billions of dollars are being spent that they don't have. Meanwhile, there are multiple thousands of residences in Tennessee, North Carolina, even Virginia, South Carolina that are suffering, that have been forgotten, that have been abandoned. They don't even have the resources to find their loved ones that they lost, preventing them from death certificates to get life insurance and things like that. So you can't tell me that we have a great economy and that everything is okay. Meanwhile, there is carnage going on and people suffering. Our own community American community and citizens. You can't say that. But nevertheless, you guys, we're at a deficit spending right now. Okay. 624 billion. This is the per year. Okay. We have 37 trillion in debt deficit, but so far the spending this year is at 624 billion. You guys, that's up 64% right here. You see that over last year. That's absolutely despicable. This is not good. This is Weimar Republic type stuff. So here's 2024, 1.83 trillion in deficit. In 2008, it was only 0.45 trillion in deficit. So in other words, I see no slowing of inflation here as far as the printing and reckless spending of the government. And the market agrees. So here's the market's expectation 5 years from now. This is called the 5-year break-even inflation rate. This is something that for some reason the Federal Reserve looks at a lot. They want to make sure that the market's expectation of inflation is grounded. So they have been doing work to try to get inflation down to 2% and the market's expectations down to 2%. But what you see here, guys, is basically you see that the Federal Reserve is useless. They are absolutely useless and they are lying to us. And that's part of their job, is to lie to us. I just want to show you guys before lockdowns, okay, 2019, look at the expectations inflation, well under 2%. All right. So all of this time of quantitative tightening, which happened right about here when the expectations were at its worst, all that time, and they never could get expectations under 2% except for this brief period right here. But it has become unanchored and shot back up, which means more than likely, you guys, unfortunately, inflation is going to be sticking around. Now, on top of that, there's plenty of money in the Treasury general account. So them talking about raising the debt ceiling is frustrating because, again, I just showed you guys the banks have a lot of money. The deficit is crazy. And the Treasury general account has $719 billion. Look at pre-COVID. I'm sorry, I used a bad word. Pre-lockdowns. Look at this. They only had about 200. Since when did we need 719 billion, Mitch? My God, people forgot. They got plenty of money. They don't need any more money. They need to cut reckless spending is what really, really needs to happen. Now, what I'm going to do, guys, is we're going to go on into our next video. Let me tee this up, and then we're going to get back to Mitch here. But our next video is going to be on how inflation is stubborn, and the market is starting to expect inflation to remain. All right, so that's going to be our next video. Let me get that teed up here. I'm going to put you on mute right now, Mitch. And I hope you guys enjoy. Oh, and let me know that the audio is okay.
Margie, don't worry. Listen, we know you're not a political person necessarily. You're here to talk about the markets. But this news just breaking, as a market person, is there any movement or fallout from this news out of D.C.?
Well, I think it's positive. It shows the Republicans are more or less united to trying to chip away at Trump's very, very ambitious program for the economy. So that's a positive. Okay, so it's not like you're going to go out and change your strategy or buy this, but not that, because of this news that it does look like, for all its dysfunction, there is a little function in the junction known as DC. Yes, and I think the big thing actually is that in a more general sense, there is probably no likelihood of increasing the corporate tax rate, which was a big increase before the election. That would have been a real on the market this year.
I have a very simple question about bond yields. What the heck happened to bond yields? I mean, in September, we're looking at a 3.6% 10-year. The Fed cut rates. They did the bazooka, half a percentage point. You know, they were talking up the economy and cutting rates, which I found odd, but whatever, they're the Fed. All of a sudden, in the last 90 days, 60 days, bond yields have gone from 3.7, 3.8% to 4.6%. What did the vigilantes see?
Well, I think they see that inflation is going to be a lot more stubborn than the Fed had hoped, and it isn't going to be as sensitive, and especially if the Fed is cutting rates. Also, the Fed has shown itself to be very, very sensitive to damaging the economy. So I think it says basically the market thinks that the economy is very strong, so it likes it. And two, it says that inflation is likely to be higher than certainly that 2%, maybe around 3%. So bonds aren't quite as attractive as they were, say, versus equities with that scenario.
Well, how much is the stock market related to, or I guess symbiotic to, bond yields? Meaning that if we get a 4.75 10-year or a 3.75 10-year, does NVIDIA fall 20% or go up 20% based on where that number is?
Well, I think we've seen in
Volume
the
stopped.
bond market over the last few years, and you can relate to this, that really the bond market has become more or less detached from the equity market. And I think it's because so much activity is away from the balance sheets of the banks, which the Feds used to control in private equity, private debt. So that's why we're seeing these movements we can't explain. But basically, if the economy is going to grow 2.5% or so, and inflation is, say 3%, really a bond yield of 4.5% is really not going to be an impediment to economic growth. Certainly a company like NVIDIA won't have anything to do with the growth rate or their PE.
Yeah.
If
Mitch, are you lagging right now? Can you hear me okay?
No
It
volume.
looks like you're lagging a little bit there. That's all right, man. We can hear you.
Test.
I'm not sure. Yeah, we can hear you. We can hear you, buddy. You seem a-okay. Can you hear me yet or no? Still
Can't
not?
hear
Okay, that's
anything.
fine. You can't hear anything? You guys can hear me, right? Yeah, you guys can hear me, right? Turn your volume up. All right, so I'm just going to keep, let's see here. Appreciate you. Got Thomas, new member here. It's you, Mitch. I don't think that they can hear you, buddy. Yeah, they can hear, see, they can hear us both. I think that you're just lagging, Mitch. I think you're lagging. Okay, now you're muted. All right, well, I'm going to, as Mitch is going unmuted here, let's see here. I'm going to go into a couple questions here. Mitch, unmute yourself when you can hear us, but I wanted to ask you guys, and I want to ask Mitch, whether or not, you guys think that rates are going to stay elevated. Mitch, you're still muted there, but whether or not rates are going to stay elevated, even though they're not really elevated because we have multiple decades of rates over 7% for a very long time. Now, as far as keeping interest rates above 5%, say for residential mortgages, I hope that they stay elevated because we need demand stifled down and we need supplies to come back. So overall, unless we go into a massive depression or recession and they have to do emergency rate cuts, I don't see why rates would go down very much at all. Now, obviously, the federal funds rate and residential mortgages in the 10 years all different. Mitch, can you get yourself on volume yet? You good or no? Let's see here. Appreciate you guys for supporting. You still can't hear Mitch? Can you hear? Go ahead. I see you got off volume now. Huh? All right. So I guess what we'll do here is I want to pull up some comments right here. We can hear you, Mitch. All right. He'll come back on. A couple of comments here real quick. The first one's from A Night Cry. Look at Argentina to see how much change could be affected. That was from our last segment. Appreciate you. 2% inflation is adding 2% money supply year over year. It's telling you point blank they are going to steal from you. So inflation is a wealth transfer, a very evil tax on everything. Do you guys agree with that? Inflation's awful. Absolutely disgusting. Let's see here. That's a certain part of the government doing this on purpose, trying to get money out of you. They don't like the real America. I mean, inflation is absolutely evil. It's absolutely a horrible thing, you guys. And to really make profit right now and to invest like we were before, it's to be part of the system and to be part of taking advantage of people and part of this whole inflation. I don't want to do it. Want to beat the system, become as debt-free as possible. I agree with that. Here's Mitch right here. Hello, Mitch. How you doing, buddy?
Okay. I don't know what the heck just happened there, but it's okay.
Of course.
I heard up to a certain point, just the last section of the CNBC video.
I see. Well, I have some questions for you. This is a good comment real quick from Wally. Christina, I sub to private equity hedge funds to prep foreclosures for sale. I'm getting calls. Some have started now. Was told to expect a wave in May. Touched over 2,000 homes in New Jersey around, what is that? The 19th or 20. Okay, 2018, 2019, 2020. Thank you, Wally, for that information. But Mitch, I have a couple questions for you, sir. Let me remove this real quick and we'll go back here. I appreciate you guys allowing us to deal with that technical difficulty, but it wasn't on my end. It was on your end, Mitch. Mitch, as far as the rates, okay, federal funds rate or residential mortgage rates or the long end of the yield, do you expect interest rates to stay elevated? They're not even elevated. It depends on your opinion of elevated, but Do you expect interest rates to stay about where they're at right now? Federal funds rate, maybe about 4%, residential mortgage rates, mid to high sixes, low sevens. Do you expect, as far as interest rates, to stay neutral this year? Do you expect them to go up? Do you expect them to go down? What is your expectation on as far as interest rates?
The Fed is completely irrelevant at this point because nobody trusts them worth a damn. And then one of the comments, so when you talk about this, the inflation, you have to look at the CPI, Consumer Price Index. And the truth of the matter is the books are cooked. And Travis has a schedule on the CPI as put forth by the Bureau of Labor Statistics that says every few years they monkey around with the formula and take elements away. Well, an element, which I did not know until a few days ago, I was actually looking at it. So if you look at somebody who has a mother or father in assisted living or seniors care, do you know that that's not counted in CPI? So I have that circumstance. And we were told that there's going to be a price increase in the overhead. And it's pretty substantial. It's $500 a month. Well, that's not in the CPI. So my point being that your interest payments, et cetera, well, if that's not in the CPI, then by definition, the CPI is the ultimate big lie. Well, if the CPI is the ultimate big lie, then clearly inflation is going to continue to run. Then, interestingly enough, there's also another schedule that we've got talking about milk or the cost of a hamburger. Well, in milk, there's 8 elements of real estate inside of your glass of milk. Well, if you think about it, every one of those property owners has to say, well, I've got to get a rate of return on my money because my cost is running. So you see, it's cumulative. It's hopping up the chain. It's cumulative. It's compounding. Property 1, property 2, property 7, property 8, inside of your glass of milk. Well, that's inflation. If that's not taken into account into the definition of CPI, then what Travis was just showing with regard to the inflation rate on the Fed numbers is a straight up lie. It is a narrative. It is not true. And therefore, the risk is much greater than what the market is perceiving. And there is the big problem.
This is a nice comment that seems like it's a problem as well. People who work for our government unsupervised. I would say the unsupervised is a problem, or the lack of enforcement. Couple comments here, Mitch, I think are good. Here's one from Greg right here. Heard my local radio station talk about the federal government laundering money like Joe Rogan talked about in a recent podcast. I mean, I kind of feel like they made the game book on money laundering, Mitch, especially if they're, and the banks, not just the Federal Reserve and the federal government. The banks are leveraging up our collateral and assets. Did you guys give them permission? If you did, it's probably unknowingly. They're leveraging up our assets, pensions, treasuries, houses. They're the ultimate money launderers. Here's a good one from, okay, this is interesting, from Wally right here. Okay, been in the real estate game as builder, contractor, investor since 1980. I'm sitting on cash and I'll be ready to pounce. All right, very good. Good for you, brother. Thomas, thank you. Welcome. You guys, I have so much coming out. You guys are going to be, your heads are going to spin. All right, here's one from Blackwalk will come to the rescue. They have billions waiting. I think that, first of all, the math is not adding up for the institutional investors. The biggest institutional investors have become net sellers, so they're actually selling more property than buying. If you guys go to San Antonio especially, you'll see listings, active listings that are being sold from institutional buyers, and they're never supposed to sell property. They're selling property because it just doesn't math up. But I will say that I wish that there was more law and regulation to keep institutional investors out of the housing market when it is pertaining to SFRs. Condos or townhouses. If they want to do multifamily, right? Do multifamily, that's fine. And another one is Airbnb. So Airbnb, honestly, I think Airbnb is worse than BlackRock in many ways. It's hard for me to say who's worse, but they're bad as well. A couple more things here. The inflation will lead to a breakdown in the economy. Clark, all argue it's already led to a breakdown in the economy because it's led to a breakdown at home, at Main Street. Wall Street appears to be okay. Now, here's a good one, Mitch. If you can respond to this, and then we'll move into our next segment, which is going to be the mortgage segment. But this is an interesting, because he's got a point here. Okay, the Fed is never irrelevant. They are the game. They did create systemic inflation. They did create mortgage-backed securities, and they did screw us. So Ray, he kind of has a point. If they're here, aren't they relevant, Mitch?
I'll take the opposite side of the argument. Thank you for 100. The Fed is existing since its inception to protect the banks. When this blows, this will make 2008 look like a piker, because in reality, you now have the rule of 72 raised to the power of 2 since the time of 2008 to 2024. And that is why when this blows, all hell will break loose, because this will not be able to be rescued. And that's part of what I'm going to say at this meeting coming up on Wednesday afternoon. I've got the proof, I've got the math, and the Fed has done this. It cannot go on anymore, because you're at the tipping point in that mom and pop do not have the money to cover off 1.38 million, comprised of both the federal U.S. unfunded liabilities and the federal national debt, plus roughly $250,000 per household from the result of the local taxing entities. So on one hand, I hear you, I get it. On the other hand, the Fed is the purveyor of inflation, as is your local taxing entity. They are purveyors of inflation. These two are culpable. These two have stripped the equity of mom and pop. And when this blows, either they change these real estate taxes and do as we're saying, or this will blow.
Well said, sir. So I'm going to move on now to the mortgage part, but quick shout out to you, Matthew. I see what you're commenting. I don't like to mix my religion into the economy and all that type of stuff, but man, you're speaking my language here. And I will just comment real quick, Matthew, 100%. This channel is about being safe as consumers and learning what red flags are and overcoming that. It is not about making money off the backs of our community. All right. So I don't want to be a part of that. That's why I don't sell anything. But yes, don't love money, love your life. And for the love of God, be careful with your investing. There's a lot of traps out there. Appreciate you for that, Matthew. We're going to move on now. Let me do my next timestamp to the mortgage part. Mitch, very good as well. So let's go ahead and let's get started on this other part right here. So we're going to go into this part now, guys. Here's what we're looking at as far as residential mortgage rates. Remember the 10-year tracks this, the 10-year right here, okay? So what you guys see here is you guys see this 10-year. Okay, what is this up here? Did your mutual funds fail to match the U.S. stock market? Okay, anyway, so remember, this 10-year right here is impacting residential mortgage rates. So being that this is up 3 basis points, 100 basis points is 1%. 3 basis points is 0.01%, right? You guys get it? So this is up about 3 basis points, which will mean that today, as long as it stays up 3 basis points, that this will probably updated and this will go up maybe 1 to 2 basis points. What you guys are looking at right here, again, today's mortgage rates, this is as of Friday. This will update probably around noon or 1 o'clock today. But right now on the upper left right here, this is a lot of what people quote on TV and mainstream, because this is your conventional mortgage rate right here. So the upper left at 7.1% is your conventional. Most people like conventional mortgages because you can get that mortgage without mortgage insurance. That is literally pretty much the only advantage over FHA. Because as you'll notice here on the middle, on the bottom right here, FHA has a substantially lower interest rate, an average of 6.42%. And generally, depending on your credit score, remember, conventional is your credit score really matters a lot to your interest rate and your private mortgage insurance. FHA, it matters, but not that much. Your mortgage insurance is always the same on FHA. On conventional, it varies. So basically, unless you have a credit score over 740 and a higher down payment than 5%, generally your mortgage insurance will also be lower on FHA. So FHA, you have lower interest rate, you have lower mortgage insurance, and you have lower down payment and other requirements. But there's a big but. Remember, mortgage insurance never goes away. But look at also, this is very interesting. FHA is also lower than VA today. VA is sitting at 6.45%, so also much lower than conventional. And look at your 15-year. FHA and VA lower than your 15-year. A lot of people, including Dave Ramsey, like the 15-year mortgages because you don't pay as much interest, but that's sitting at 6.49%. Let's move on now. Here's your amortization schedule. You guys know I love talking about this. Now, when people, if you ever get bullied, if you're renting right now, I'm renting, by the way, the house, this is a house I'm renting right now, but I also own, but I am renting. And I hear all the time, like, oh, Travis, you're wasting 100% of your money by renting. But what I'm going to show you guys is I'm going to show you guys the math on how if you guys just blindly purchase a house, your interest rate will be over 200%. So unfortunately, and this is a very sad thing about America and the housing market, unfortunately, it's hard to make the math work if you want to buy a house right now. That goes against the American dreams. We can go on all day about why that is, but it is very difficult to afford a house right now and to get the math to make sense, which means, you guys, and this is what I've been beating the drum on, it's very dangerous buying a house right now. So if you are going to buy a house right now, make sure you have all your ducks in a row and you understand what's going on in the housing market. But right now, as you can see, this is an amortization schedule. If you get a loan amount for $324,000, you guys pay back $783,000 in just interest. That means that the true cost of interest in this scenario at a 7.1% interest rate is more like 140%. In the first 5 years, if you guys pay down your principal balance from $324,000, which is your original loan amount, if you pay that down about $19,000 and you pay that right away down to $19,000, you save the first 5 years in interest. But if you do that in your second year, you'll save these columns of interest. My point is, it doesn't take a lot of money to get out of that amortization schedule. It just takes a little bit of discipline. In other words, you guys, the sooner you pay down the principal, the better. And if you guys want to make the optional payments, and I showed you guys this the other day, say you put $500 more towards principal each month, we calculate that. If you do that, you turn a 30-year loan into a 17-year and 10-month loan. So you can have a 30-year fixed rate mortgage, but you could still pay it off in 15 years. You just pay a little bit more money towards towards your principal. Now, if you guys pay the $500 more per month, you guys actually save $212,000 in interest. So in other words, you guys know what you're doing, right? Being aware is part of the way to be successful. But I want to tell you guys, this is only counting your interest. When we count property taxes and we count homeowners insurance, you guys, and we count mortgage insurance, you guys see I put that right here. 2% property taxes, homeowners insurance, about $2,100. I terminated a contract because the homeowners insurance came back at $5,400 freaking dollars per year. $5,400 per year for insurance? When did that happen? So anyways, guys, here's what I wanted to show you. If you guys purchase a home for $350,000, you would pay back approximately, in 30 years, $1.08 million. Okay. So your true cost of home ownership, if we compare it to renting, especially, is about, let me see, I wrote that down just in case I forgot it. Oh, here it is, 209%. Okay, so if you want to blindly buy a house and you want to just follow that rat race, you want to follow the herd of sheep, you pay back 209%. It's better off for you renting. Now, if you don't want to be part of the sheep, then look at your mortgage. Also, guys, I want to make one thing else clear real quick, and then we'll get to Mitch. If you refinance, you start this all over again. Okay, so if you refinance, you have to pay all these heavy columns of interest again. So you guys may not want to refinance, is the point I was trying to make right there. And if you do refinance, definitely make sure it's the right thing to do. A lot of people will refinance, Mitch, if they save a little bit of money, like they'll save 1% on their mortgage rate. But what they don't realize, the thing is with refinancing, the longer you have your loan, generally the worse it is to refinance. So if I've been paying my loan for 7 years, but I refinance back into a 30-year, that means I have to start those 7 years I pay down all over again. And the banks just get filthy rich keeping your, that's why you guys see refinance. Do not refinance if your mortgage rate drops only 1%. There's a lot of things. Now, real quick, I forgot to go over this, and then we'll get to our video here. Now, what you guys are seeing here, let me switch my camera one more time here. All right, so here's the mortgage application. So this is demand, all right? Now, let's start with the refinancing demand right here. Let me go, this is the 5-year. Now, the refinancing demand is in the gray kind of lines right there. You can kind of see that. This is interest rate. The orange is interest rate. And really what I want you guys to point out is refinancing is in the gutter. Look at where it was here up into 2021, way up here. It's now in the gutter. So the mortgage industry is not doing well. Same with purchase applications. You guys see, I mean, look at how much rates went down and it pretty much stayed the same. It did go up though after the election. So this did actually trickle up after the election. It was very interesting to see that, but it's in the gutter. So demand is still in the gutter. That much is clear. No speculation needed. And we're going to move on, Mitch, to our video on total mortgage applications falling 21.9%. Okay, so, and then we'll come back to you. Let me kind of cue that up right now. And if you guys can that are listening, let me know that the audio is good and we will get this started.
Demand out just moments ago. Diana Olick joins us right now. She's got more on that front. Hi, Diana.
Hi, Becky, and I'm going to give you 2 weeks for the price of one because the NBA was closed last week. Mortgage demand positively cratered to end 2024 thanks to a sharp rise in mortgage interest rates. Total mortgage application volume for the 2 weeks ending December 27th dropped 21.9% compared with the week before that period. That, according to the Mortgage Bankers Association's seasonally adjusted index, and an additional adjustment was made to account for the Christmas holiday. During that time, the average rate on the 30-year fixed increased to 6.97% from 6.89 for loans with 20% down. Rates were 21 basis points higher than they were the year before, and that's a big change because they had been lower on an annual comparison for much of 2024. Applications to refinance a home loan, which are most sensitive, of course, to interest rate moves, fell 36% from 2 weeks before and were 10% higher than the same week a year ago. Applications for a mortgage to buy a home fell 13% during the 2 weeks and were 17% lower than the same period 1 year ago. While December is typically the slowest month of the year for home sales, these numbers, again, are seasonally adjusted, and that annual comparison is showing considerable weakness. There are more homes on the market now than there were last year at this time, but many of those homes have been sitting for months due to higher prices and, again, these higher mortgage rates. This read on rates is an average for the week, and it's a bit messy with that 2 week read again. A separate survey from Mortgage News Daily has the 30-year fixed rate now over 7%. There will likely still be plenty of volatility in the rates today due to the holiday yesterday, but the trajectory appears now to be higher. Back to you guys.
My face got really big just then. Mitch, I have so many comments to pull up that are really good I'd like to address. But before we do that, can you explain in your opinion why refinancing your mortgage could be so bad?
Well, all it's doing is delaying the inevitable, which is you're likely to lose the house, because what's going on here, that amortization schedule that you showed, if the, and nothing else, I mean, nothing else, all this nonsense, all these indicators, it doesn't matter. There's only one thing that matters that nobody wants to talk about, and that's the median household income. Well, for sake of this conversation here this morning, that median household income, and Clark a minute ago was 100% correct, that median household income is your household income. So if you look at that amortization schedule that you put up and you realize that anything under $80,000 in income would put that homeowner $20,000 upside down. So going to refinance when you're $20,000 upside down in the yearly cost of having that house is insanity. You're broke. You're going to lose the house. And that is the ultimate problem. Nobody's talking about this. The only thing that matters is the median household income. So, you know, if you're $20,000 upside down, that means the odds are you're relying on credit cards. So not only do you go and refinance the house, but now you've got a credit card debt problem. You're going in the exact opposite direction that you should be going. And that's what the system is doing. And I think Angela made a comment, are the banks doing the same thing that they did in 2008 and pumping money? Yes, irrefutably. There's home builders out there that are selling, well, it's $50,000 less off the purchase price. Yeah, but they own the mortgages. They're making it up on the backside. They create the paper. They sell the paper. They're fine. Whereas you just paid for a house that you can't afford. And God forbid your spouse loses a job. Now what are you going to do? So all these things have to be taken into account. And unfortunately, they're not. It's not built into the amortization schedules that the lenders use. Either you know it or you don't know it. And the problem is that the vast majority of the public don't know it.
Mitch, we could do this all day. I already know, man. So, all right, I got like 7 comments. Here's the one that you said from Angela. So Angela's asking, do you think lenders are starting to do what they did before the 2008 crash? That's known as, in the industry, that's known as the subprime collapse, where lenders were lending to borrowers that weren't proving their income, or they were lending loans to people that couldn't afford their mortgages. You guys get it? They couldn't afford it. But the way they were doing that is by doing things like stated income, called CISA, or NINA, which is stated income, stated asset. NINA is no income, no asset. And also the 12 maths, payment option arms. So they're still, here's the thing, Angela, they're still doing it. But the problem is that I see is people are more confident right now because there are certain restrictions and verifications that are happening now versus then. But the problem is if Fannie Mae and Freddie Mac are still buying the loans that are not being written properly, which we know that they're not because of 2019, the CFPB review, it doesn't matter what the regulations are, because they're just going to sell them to Fannie Mae and Freddie Mac, and they're not going to adhere to the QM laws, the Dodd-Frank Wall Street Reform and Consumer Protection Act qualified mortgages, which had debt to income ratio threshold. They just got rid of that. So yes, they are. They're just doing it in a different way. That's my answer there. A couple more things here that are really, really good. Here's from Clark. I think, did we already talk about this? I have seen some companies liquidating properties down here in Georgia, taking equity from people's homes, underpricing their inventory in several subdivisions. So that's probably institutional investors. Ray has this comment right here, Mitch. This is pretty hardcore, pretty real here. Yeah, you get out of college. What will you do to buy a house? Houses around here start at maybe $350,000 if you're lucky. How can anyone start affording that? I mean, Mitch, you want to go into how hard it is for young adults right now to purchase homes, and maybe some strategies on how to purchase a home? Now, I'll just say real quick, one of the strategies that I would say is be patient and understand the math. You do those things, you'll be all right. It may take a little time, but understanding the math is important. Being patient, very important, because purchasing a home is so emotional for most people. Mitch, what do you got?
We have to back up here for a second. We are at the tipping point. So it's not just subprime housing or subprime loans on the housing that is the problem. Your cars have subprime auto loans as well. They are defaulting at the same pace as the credit cards. So credit cards had a 50% increase in defaults in less than a quarter. So when you start realizing, okay, credit cards, subprime auto, housing loans, we're at the tipping point, which is why we've been pounding the table on this. The mom and pop do not have the money. It simply isn't there. That's the math. 32% of the population, household population in Denton County, and that same math is tracking across the United States and all the research we've been doing. 32% cannot afford the roof over their head. Well, think of it this way. If 30,000 houses in any county, be it Denton County, any large county, 30,000 houses hit the market at the same time, what do you think is going to happen to the housing value, a purchase price at that time, when that amount of inventory hits the market all at one fell swoop? Now, take Denton County and multiply that across the United States in 3,143 counties. See, the economic disaster is right in front of everybody's face that nobody wants to talk about, but it's coming. And the problem is the real estate tax is because your tax on your houses in reality is close to 9% of your income. You got $80,000, you just pissed $7,000 of your $80,000 income down the drain in taxes. They're forcing mom and pop into bankruptcy or losing the roof over their head. As that case that just I sent to Travis this morning, 35% of the students in that particular school district are homeless. So the idea, the point to your question, Travis, is, well, is there a strategy? Yeah, don't buy. Sit still. Sit still, because you're going to be able to pick this stuff off. What you're thinking right now, well, I can get it $127 a foot, $150 a foot, whatever the number is. Yeah, well, don't you think for an extra 30 or 40% discount on the value of that house, whatever that house happens to be at that time, assuming you want it, is worth it? When you look at the payments, what that money will save you, if you get a 30% discount versus paying over the next 30 years on an amortization schedule, well, okay, congratulations. You just stuck $600,000 in your pocket. Patience pays, especially in this point in time, because there is no clarity out there. People's heads are screwed up because, well, the stock market is great, everything's wonderful. No, it's not. Look under the hood. What is creating that fraud, that illusion of the stock market? That's paper chasing paper. Price is what you pay, value is what you receive. Where is the value in buying a company on 100 PE multiple? The answer is 0. It's paper chasing paper. When you buy a house, that's an asset. It has a value. If you buy it at the right price, you received the value. If you overpay and the market goes down, you're upside down. If your spouse loses a job, you're upside down. And it's big money, right?
Yeah.
20,000 against upside down against an income of 80,000, you're done. There's no way to come back from that. So patience. That's the strategy.
Patience.
And
Hey,
fight
that's
like hell to get your taxes reduced.
hey, you can't take mine. That was a great answer, man. That was a great answer. Let's keep moving on here. Clark, this is a good comment. I think Clark's a realtor. Clark, are you a realtor? Remind me. I think you're a realtor. One of the good ones. It appears. I feel sorry for those people that were tricked into buying a home and told that they can refinance in a year or so. And he's going on to warn: never buy if you can't afford the current rate and price. You have to be smart. That is so accurate.
Amen.
Right there. There's so many people that were tricked, like, oh, you'll be able to refinance next year, not even explaining the amortization schedule. That's why I'm saying, like, you got to be able to afford it right now. Don't expect on refinancing. If you want to get out of debt, you got to pay extra money, not refinance. Stop talking about refinance unless maybe your rate drops 3% or something else. But there's ways to see, right? Can I save money in the long run? There's so many ways to do this. There's so much math. Let's keep going. Another comment here from someone else that's frustrated with young buyers. Young people have no chance in buying a home. My grandson has been looking for the last 6 months. A lot of people frustrated still. Mitch, this is from Ryan. He asked a couple times, are you helping in Pennsylvania? I don't know that answer. Are you helping in Pennsylvania?
There's been 4 cases that have come our way out of Pennsylvania. New Jersey is another hotbed, big time, of problems. Ohio, Illinois. So what we're doing is we're collecting PDFs of evidence. And one just came through, which Travis has a clip on from Spokane, Washington this morning, which is a straight up admission of guilt. I mean, they literally have publicized what they're doing using predetermined budgets from which they magically derive a real estate value. The problem is, under real estate law, there is 0 connection between a predetermined budget as handed to them by a taxing entity to the value of real estate. In other words, they've admitted guilt of violating all appraisal laws ever written. Well, so what we're doing across the United States is we're collecting that type of information. So if somebody's got a case where all that information stacks, yes, we absolutely want it, because we will turn it into exhibits on what we're doing in this current lawsuit. I mean, at this point, we've got enough evidence to show exactly what's happening across the United States, which is that these taxing entities are violating every single appraisal law ever written. However, they're also violating SEC laws. They're violating IRS laws. I mean, this is quite a problem, and they're caught. The math shows that they're caught. So now the question is, what's really important here? Well, what's really important here is to restore the balance sheet to mom and pop. And the only way to do that is the elimination of the real estate taxes in favor of a uniform all states, sales tax. Then you've restored the balance sheet. So on that amortization schedule that Travis showed, well, that's a 30-year amortization. Wouldn't it be nice after 30 years of you paying down your amortization, you actually owned the land beneath your feet? And that is why we're doing what we're doing.
Well said, Mitch. All right, so that was a yes for everyone that was listening there. Yes, he does help pretty much everyone in the nation. This is from Ann. A little bit of frustration here. I want to know when the overinflated housing prices will stop going up or reduce. And so I have a course. It's free. Please take it. It is in the link in the description. The thing is there are some metro areas that are been going down. Like Austin has been going down since about 2022. Every single year it's been going down. But what I want you to understand, Ann, is this is why it's so important to understand the math and how real estate works. You have to go subdivision. You have to go hyperlocal. So take Austin, for example. Everyone knows is crashing, right? It's like one of the worst metro areas. But there are subdivisions within Austin's. And remember, subdivisions like the neighborhood. There are some subdivisions in Austin that are still going up because there's such high demand. And there are some subdivisions in Austin that are going down. It depends on the subdivision. And even when you get to the subdivision, there are some sellers that list their price for over market and some sellers that list their price for under market. The key is understanding the comparables, being patient, all of those other things. So when it's already happening, when is it going to happen in the entire nation? I'm surprised the housing market has gone sideways for as long as it has. I expected the housing market to get real bad and stay bad since about mid 2022, which we saw. But what we also saw is a Federal Reserve that is going to stop at nothing to save the banks, and that's not good. Question for you, Mitch, and then we got to get into our last section here. How does COVID inflation compare to the great inflation in the 1980s? Do you have an answer for that for him?
Yeah, so COVID inflation is a ramification of the fact that the market was closed. In other words, Main Street market was shut down because the market itself globally could not operate. Well, that created supply chain problems. And when you've got supply chain problems and you can't get parts, then you have demand, but no supply. And that automatically creates inflation. And I'll want to tie that right back to the very last sentence that Travis said a few minutes ago. In terms of the pricing of housing, you're going to end up with a bifurcated market. In a bifurcated market, if you look at it from the standpoint that you're a house builder, well, your pricing of product, bricks, sticks, concrete, stone, whatever it is that's going into that house, countertops, depending on where they're coming from, that cost of goods continues to rise because every element that is inside of those cost of goods, let's say it's a Silox countertop. Okay, there's probably 4 elements of real estate tax built into that Silox countertop. So your house builder is being forced to pay multiple layers of real estate tax on top of the product. And each one of those layers is taking a higher percentage because they've got to make a rate of return. Well, that's called inflation. So at the house builder level, you're going to have continued inflation up until the market cracks. Now, what will happen is when the market cracks and the value of the houses, existing inventory, let's call it 4 years and older, drops 10%, 20%, 30%. That is how the home builders are going to get crushed because nobody's going to buy a house on an inflated price when they can go buy existing inventory at 30 or 40 cents less. So let's call it 60 cents on the dollar. That's a big spread. And that is what's going to break the existing single family homes. They won't be able to sell their product. And now, right here today, you're starting to see home builders at, well, 50,000 off, 200,000 off, right? Well, 200,000 on $1 million home, that's a big ticket. And the question is, what are they doing on the backside with the mortgages to try and make it up? The point of the matter is, it's breaking. We are at 2008. This system is broken and it's going to get worse. And the only thing that can fix this is eliminate the real estate taxes and give mom and pop back the ability to own the land beneath their feet.
Well said, sir. We're going to move on, Mitch, to the Federal Reserve and property tax portion of this. Let me add a chapter real quick. Now, here's where I would like to start. Want to give you guys take a look at this, okay? Look at why property tax is illegal, zero hedge. This is from Mitch Vexler. Got in zero hedge on Friday, January 3rd. Props to you, Mitch Vexler. Man, I wish I could write, Mitch. I feel like I could talk and do some videos and fly a drone, but dang it, when it comes to grammar, I am so embarrassed in myself. But I just wanted the viewers to know, I mean, you are making, and as a community, we're all making progress moving forward. I mean, there are people that are listening. You're in zero hedge. We've been referencing zero hedge. Big respect to you. Do you want to go over quickly? Obviously, we have like 10 videos on this very subject, and we made that masterpiece, which was almost 2 hours long on this. But can you talk to the viewers about what this means to you and maybe a little bit about this article that you want to include here?
Well, it really is all hands on deck type effort. So you'd be surprised, but sometimes there's the odd comment that is not totally dead on point, but it gets me thinking. So it's the combination of these things that start these articles. And when I sit down to write them, it just shoots out of the end of my fingertips. So it's stuff that's going on, but it was focused because somebody made a comment. Well, that's the result of what's here. And then Zero Hedge reached out. And so this is the first article. They've already got the second article. I sent it to them 2 days ago at around 3 o'clock in the morning. The third article is in the process of being drafted, and Leslie will get busy and just clean it up, and it'll be out by the end of the week. So what that's showing in right there on that particular spreadsheet is exactly what we were talking about this morning, that the amount of debt load on mom and pop puts them upside down. And so what you're seeing here is you would have to have $9,000 a month over and above your current income to pay off the 1.38 million, comprised of 1.1 million of US national debt and unfunded liabilities, plus roughly $250,000 in your local taxing entity debt. In other words, that spreadsheet, which actually Leslie figured out how to break it all down. So we broke it down using A divided by, or B divided by A kind of thing. So we're showing people how the spreadsheet actually works. The point of the matter is, there's no mom and pop that I know in the United States that's got an extra $9,000 a month to cover off the debts created at the hands of the Federal Reserve and your local taxing entity. That spreadsheet shows why we're at the tipping point. What we've been discussing here this morning is built into that spreadsheet. I think
good.
that article in Zero Hedge is hovering around 80,000 reads so far. So
Yeah.
it's moving.
Yeah, it's moving. I mean, this is so great. I'm so proud of you. And you guys go to Zero Hedge as well. Johnny has arrived. His first comment, man. I don't know where Johnny gets his stuff. Here's his comment, Mitch. I'll read it. This is a buddy of mine. He likes to troll a bit, but he's saying Carmela could have fixed all of this, but we got the Cheeto Puff instead. I mean, this guy, man, and I love him. I actually stayed with Johnny during my trip in Sacramento in the housing market when I met up with Jason Walter as well. Johnny's say what you will about Johnny, but he's a great person. Mitch, I want to get to the questions. We're at about an hour and 11 minutes. But before I do that, do you want to go over this article that you made here about quantitative tightening versus inflation? And then we'll kind of exit out of the program by responding to some of these questions and comments.
Sure. This article is literally driving a freight train over the Federal Reserve. It's very short. It's very specific. But as we spoke this morning, so as not to belabor the point, paragraph number 2 gets the job done. The actions of the Fed are purely schizophrenic. They're only there to act for the benefit of the banks. The overnight reverse repo is putting money in the hands of the banks because the Federal Reserve said, well, you have to increase your capital reserves. So what we're going to do is we're going to give you some treasuries from which you can borrow from us. In other words, the overnight repo is a fee paid to the banks, which in reality is used by the banks to keep the lights on. Now, it's not all banks, but there are a tremendous amount of weak banks. Let's call it 700 out of roughly 6,600 remaining. So that's a pretty big number. Well, those banks have access to those overnight repos, whoever needs them. So right now, the overnight repo is down, but you have to understand the Federal Reserve can literally bring it right back up when there's stress in the market. So the fact that it's down doesn't mean a hill of beans. What means something is let these banks go bankrupt if they're not going to keep the notes on their balance sheet and if they don't have the capital reserve to sustain their ability to put mortgages into the market. Because other than that, they're completely useless. They're literally sucking up mom and pop's money to cover them off. That's what's in paragraph 2.
All right. What about paragraph 3? What about paragraph 3 there?
Well, okay. So what paragraph 3 is saying is in the last 5 years, the fraud committed at the local taxing entity level, which owns your school districts, which owns the CAT, so it's your school districts, which owns the central appraisal districts. In the last 5 years, those central appraisal districts have committed 21.25 trillion worth of property overvaluation. These are fraudulent overvaluations over and above regular market conditions if you stuck to the appraisal math, okay? Now, what happened in 2024 as a result of that 21.25 trillion is that in 2024, they stole 450 billion across the United States from mom and pop. Then this morning, that one short description that I sent to you, Travis, from Spokane, is the admission of guilt that, just like in the case of Denton Central Appraisal District, they're using predetermined budgets. The Central Appraisal District receives a predetermined budget from the taxing entity that says hit our number. That has nothing, zero zip nada to do with real estate valuation. And Spokane, that one paragraph is in a straight up admission of guilt, just like we have an admission of guilt from the Denton Central Appraisal District, where they took 60,000 properties outside of their database, manipulated them in Excel, their words, and put them back. There's no law that allows them to do that. The fact that they even know how to do that is a glaring red flag. That's what paragraph 3 says.
Very good. All right, let's move on to the Q&A part of this right now, Mitch. Let me just do the timestamp for Q&A here. All right, so I got about, let's be fast here, and then we'll end this out here. So a few comments here. Let's see, here's the first one. When can we expect housing inventory to skyrocket due to everyone moving to Canada like they said they would if Trump is elected again? Let's do like 10, 15-second responses here if you have any, Mitch. I'm just going to pass on this one. This just sounds like some Taylor Swift nonsense here. What's your take here on this comment?
Yeah, the political stuff isn't relevant. I live in the world of facts and math. So, but there's a good question. Like I said, there is a good question in some of these things. So when can we expect housing inventory to skyrocket? Well, do you know right now today, there's a house builder out of Fort Worth, big, national in scale, that owns massive, as in billions of land, because they inventoried the land under the theory that we're going to be building houses and subdivisions on this land, except that they're not able to keep up with the demand. Right. So in other words, the demand isn't there, but the supply of their land is there. So now what they're doing is they're going to take that land holding and they're going to put it in a REIT. That REIT is going to go out to mom and pop and say, give us money for our REIT, except that land is only worth what you can do with it. So you see the inventory of land is going up. Mom and pop are going to, if they invest in this ETF, which would be insanity, but if they do, they're going to take their chances on a future valuation. But the builders can't build the houses because the demand isn't there. Therefore, inventory goes up. Demand drops, supply increases, price drops. And that's what's happening right now today. You've got the exact same thing with builders sitting on housing inventory. They can't move because mom and pop cannot pay the freight. The only thing that matters is the median household income or your personal income. Nothing else matters.
Very good, Mitch. 10 to 15 seconds. So 10 to 15 seconds. That was
good.
I know. That was good. Here's a good one right here. I see this every once in a while. Okay. Now, so some people's concern with eliminating property taxes is basically it's going to increase the prices of the houses. I think that if we're to eliminate property taxes, there's probably some other things that need to happen. If you're going to eliminate property taxes, obviously multiple things will change. It's not just one thing. Things will be impacted. But can you respond to this? Let me read it for the viewers. I strongly disagree with Mitch. An elimination of property tax is equivalent to another homeowner bailout. I mean, but they'll take our houses, Eddie. That's the thing. I mean, we got to be able to own something. Good luck finding any inventory of property taxes is swiped with sales tax. I mean, but your expenses are the same if it's swiped. So anyways, Mitch, can you address this and take more than 15 to 20 seconds on this one if you want?
Okay. So no, the comment is not really accurate. And here's why. If you look at a real estate tax, everybody knows that they're getting hit on these taxes. Nobody is saying that the tax money, it should be stopped. It's a different story. Property valuation based on something that is fraudulently induced, fraudulently created, simply should not exist in any regular market. Taxes will still be paid. Schools will have access to taxpayer money through the sales tax, the uniform states sales tax. And what that does is it puts every citizen in the United States on the exact same playing field. The problem here is you've got all these states with slightly different laws, but the nexus between all of them is that they don't give a damn about the appraisal law that they all signed up to protect and defend under the Constitution of the United States of America and their own states' constitutions. All of this stuff is being violated. Well, that is the fraud in the system. What I'm saying is get rid of the fraud in the system, make everything transparent, and you do that because when you go to the store and you buy a chocolate bar and that chocolate bar costs you 15.6% in tax, okay, everybody's on the same page. It doesn't matter if it's a chocolate bar, a brick, a stick, a 2x4, it doesn't matter. You're all paying the same thing. That money goes into the coffers of the states. The states, along with mom and pop, say, okay, school districts, this is the amount of money you've got to spend. It's not the other way around where they get to dictate to cover off their pensions, which is exactly what's going on here, that they get to dictate how much money they're going to receive from mom and pop based on an implicit guarantee, when I was the guy that coined that term, implicit guarantee. It isn't real. I just did that from the standpoint of saying, this is how these governments are acting. They're assuming that mom and pop is going to give them an implicit guarantee, the taxing entities, to spend money in perpetuity to backstop their pensions, which is a second Social Security program. There is no other way out of this. I've got well over 10,000 hours studying this math. This is the answer. It's just a question of getting people on board to understand it. And that's what we're doing.
Well said, Mitch Wexler. All right, let's keep going here. Will DC suburb prices ever go down with the entrenched government jobs? Washington, D.C. went down last time. Now, how many jobs will be there if Doge starts firing employees? If they start having a lot of layoffs in Washington, D.C., then obviously layoffs will impact the housing market. That's pretty much a fact here. Homes are still selling like crazy here in Miami. So I brought this one up because what do you mean when they're selling like crazy? Like if they're priced right, they're selling like crazy? Because when I look at the numbers for really any metro area, it's down substantially from pre-COVID. The sales transactions are in the gutter. So when you say like crazy, does that mean that like they're like units they're selling, or does that mean like they're still selling like crazy because they're priced high and some small amount of people are still buying them? And if you're a realtor, Rick, you got to step up, brother. You can't just say things like that, especially if you're a realtor. I love you. Thank you for commenting. The real problem is the human being. Mitch, what do you think about that? What do you think about the apathy, the role of apathy in all of this? And apathy, the lack of care from the consumer. Do you think that is a bigger problem than the Fed, banks, greed, corruption, and fraud?
Einstein has a saying, those who have the privilege to know have a duty to help. I don't necessarily blame mom and pop for the apathy, right? You got decades of improper education and people think what they think. However, when we stand toe to toe in front of a politician and say, you're breaking the law, you have knowledge that you're breaking the law. And the result of breaking that law is in fact breaking the back of mom and pop, the economic engine of the United States. This I have a big problem with. So the human being in this case, if you substitute the word, the real problem is the human being, the real problem is the politicians who set this disaster up. There's simply no way, if they understood what the sources and uses were at the time they signed these laws in, that may have had good intentions, but they've morphed into something that is horribly, horribly criminal. And we're dancing on a greater depression. You either fix this or this market will blow to shreds. So substitute the word human being for politician. Yeah, I agree. That's your problem. That's the problem.
Okay, I got a comment from my buddy Charles. Eliminating property tax would greatly benefit the existing homeowners. Landlords would cash flow even more. Increasing homestead exemptions for owner-occupied units would be the happy median. So I originally put this up because, if landlords are paying less money in property taxes, in theory, they should reduce the rent for those houses. And that's kind of another way that would work. Here's another comment. My hope is that interest rates, inventory, and bankruptcies skyrocket. Foreclosures ticking up, and with school loans having to be paid again, I have difficulty seeing the economy improving. If you're not on mainstream media and you're just a normal person, Jungle Book, all of us have a problem seeing the economy improving because we are real people living in the real world. We're not part of the system, if you will, not part of making money off of people. Anyways, mom and pops own more second homes than institutional investors. That is a fact. If they sold the second and third homes, it would balance. It would actually crash the house. If all of the second homes and third homes that mom and pops own right now would hit the market at the same time, the market would crash for a long time. And here's the other thing, as far as institutional investors, a lot of people, Mitch, they point out like, oh, institutional investors only own 0.05 of all houses. What I like to explain to people is people that are showing you that chart are not giving you the entire story. What matters is how much are they buying right now? How many houses are institutional buyers purchasing right now? And that's what really matters. And that really depends on your metro area. Some metro areas are loaded with homes owned by institutional investors. Some have none. So it really depends. And one thing with institutional investors, normally they're purchasing is concentrated into specific areas like Cleveland, Ohio, San Antonio, Texas. And so institutional investors can drastically impact the housing market as well. Address the inventory issue, please. I thought we were this entire time. So I think what we should say as far as inventory issues, and here's another comment, the builders will make up the inventory issues, as will distress selling and institutional investors and banks. But here's the thing. Inventory has been going up. Obviously, when we look at just the supply and demand dynamics, inventory has been going up since what, approximately 2022, maybe mid 2022. So inventory is going up. I think that what we should be asking, Eddie, is when will affordable inventory not be an issue? Right. And that's why I'm trying to tell you right now that math is so important. When will it not be an issue? It depends on a lot of things. It depends on you, how much money you're making, how much debt you're in, what your personal goals are, and the nature of the deal, the nature of, how much it's going to cost you to buy a house. How much is the move-in cost? How much is your property taxes going to go up? How much is your HOA? How much is all of that type of stuff? So as far as when will inventory be affordable again? Probably years. I mean, we would have to have a deflation happen, people to rebound, keep their jobs, save their money. I mean, that's why, again, I say, Eddie, it's so important to use the math. And I really appreciate you commenting. Let's see here. Mitch, there's Raymond. This is my buddy Raymond. Raymond has his own channel. You guys check out his channel, especially Raymond's been with us for 2 years. So I'm really proud of him. He has his own channel now, talking about real life topics and things like that. Raymond, it's nice to see you. There's living in Omaha as well. I remember living in Omaha. I used to be here every day, Mitch. He used to be talking every day. What is the overall outlook? All right, so let's end here. You're welcome, Eddie. I appreciate you, brother. I mean, you bring up some good questions. I'm not knocking any one of you guys. I know that we have a lot of questions here. Let's see what living in Omaha has, and then maybe we can end on this. What is your overall outlook for the overall housing market in 2025 at this time next year? Will we see a price decline? So here's my answer, and then I'll defer to you, Mitch, and then we'll wrap this up. But the thing is, David, if people understand the math and they're purchasing right, and my goal is to help people with their primary residence, help normal Americans, not people that are filthy rich. It doesn't matter necessarily what's going to happen in 2025, as long as people are remaining patient and understanding the math. And if they can't access MLS, the multiple listing service, to review comps, that they're working with great realtors that will provide them a little bit of caution and tell them pump the brakes. But nevertheless, the market's sideways, brother. The prices are way too high. Property taxes, homeowners insurance, HOA, with the HOA crisis in Florida with the condos. I mean, my outlook for 2025 is some of the same that we've been saying since quantitative tightening. I think 2025 is going to be a worse year for the housing market, and we will see metro areas that have price declines, and there will be some that have and show price increases. And I will say this last thing, David, the median sales price is heavily manipulated by Redfin. By what Fred is using, median is no longer true median. So it's hard to determine what prices are doing without doing a market analysis on a subdivision using comparable data. So I think as long as we're doing market analysis, comparable data, subdivision, being cautious, it's going to happen when it happens, but patience is good. Mitch, you want to end us out of here by responding to his comment?
Yeah. Ohio is an interesting market.
Yes.
Anything that is let's call it a Rust Belt state, Michigan, values are way down. And obviously Detroit took bankruptcy several years ago. Chicago's probably next on the chopping block. So these problems, these gyrations in these municipalities, these gyrations in these states are directly, irrefutably correlated to fraud. And the problem now, as compared to 2008, is that the fraud is literally gone exponential, and it's showing up in your real estate tax. We're not, and I'm not, because I understand the ramifications of this. I've lived this for most of my career. You have to realize that when we talk, there's going to be hundreds of thousands, if not millions of people that are going to lose their jobs. This is a repeat of 2008, except it's exponentially larger. And you can't come out the other side until this cancer is shot with chemotherapy. And that is why I'm saying eliminate the real estate tax, because that returns the balance sheet to all mom and pops across the United States. So these market conditions have to be uniform so that it doesn't matter who it is, Mr. ABC in Ohio or Mr. XYZ in Miami are on the exact same playing field. And by the way, Florida's got a huge problem in their condos. So when somebody says, well, we're selling a lot of product here. Yeah, but what's the discounted price? Because you got a huge problem with the new law that says all these condos have to be brought into modern standards, which they can't. Why? Because mom and pop doesn't have the money. So Travis is 100% correct when he said all real estate is local. I want to put one more thing on top of that. It's not just the fact that it's local. The only thing that matters is the median household income. Put that in the denominator and say, how much can I afford? And if you can't afford the house, there's your answer. Don't stretch. It isn't worth the risk. The economic risk is simply too great. So if anything, that's probably the mitigate the risk before the risk even comes out.
All right. Well, I think that is well said. And, let's get the viewers out of here. You guys, just big shout out. Thank you guys for watching us. We'll go ahead and end this. Don't forget, everything is going to be linked in the description. And I'm also going to include the data points that I just went over with you. So those data points will be linked as well if you want to go back to those articles. I absolutely love you guys. Hopefully Mitch and I will be doing more lives, maybe once a week, maybe even twice a week. Either way, we appreciate you guys. You guys look out. This evening, I'm putting out one of my final Hurricane Helene videos, which is a video on the testing that we did on soil and water samples in the industrial complex in Irwin, Tennessee. It's going to be a little bit about the corruption and dishonesty that's going on there, things that we've seen that are absolutely horrible. So look out for that. I probably filmed that over 5 days. The amount of effort into that one video is absolutely overwhelming. So look out for that. God bless y'all. Hope everyone is saving their money. Happy to see REM live shows again. Dean, I appreciate you. I am also happy. You didn't save your money, brother. Save your money. I am happy that you guys are saving your money. By the time everything is settled, we should be ahead of the sheep. We should be ahead of people with great income, assets, and credit, and a mindset, and understanding how real estate works. Other than that, guys, thank you for joining us on this Monday Live. If you're out there just living your life or investing in real estate, you guys already know we wish you luck, and we hope you win.